Coming up today, why stocks fell sharply lower. Did the stock market put in a big top? The latest economic data, the China risk, the latest on Bitcoin, what stock Nvidia just bought, and I share with you details on what stock I just bought today. It's another big one, guys. Let's go. And welcome back to the Daily Market Review, everybody. On a bit of a spicy Friday trading session, finishing sharply lower on the lows for the week, and it's starting to look like Monday was indeed a bit of a short-term top there, as we had a huge rip-up last week. We had quite the pullback there today, with all the indices lower, led by the NASDAQ. We saw a lot of selling in big mega-cap tech names today. NASDAQ down 2.38%. Bit of a bump up in the VIX today as well, getting to 17.5 at one point before pulling back down to the low 16s. And one of the hardest hit sectors today, semiconductors, down 3.3%, continuing to trade heavy, in my opinion, on the China risk, of which I'll get into in a minute. And there's Nvidia pulling back from highs, down 3.2%, but we also saw large falls in Amazon, off more than 4% today. Same with Meta, trading pretty heavy to finish the week here. The media is reporting it as the market's worrying about a repricing of interest rates, which I think is definitely part of it. However, I think there's also more to it, as the market's been digesting news of plenty big investors and insiders selling out of some of these stocks as we're getting their Form 13Fs rolling for Q3. That's really been kicked off by Warren Buffett, who's substantially reduced his stake in Apple pretty much all year. And I think Apple's vulnerable to a bit of a correction here, given they had a significant miss on their last earnings. Their hefty valuation, and they're still yet to prove to the market that iPhone 16 can get them back to good growth. But more on this in a minute. But stick with me today, because later on in this video, I'll give you all the details on what stock I bought the dip on today, and why, in my opinion, I think it represents good value at these current levels. I'll also share with you the stock Nvidia's bought, and I'll show you their latest portfolio and all the stocks they currently hold. But before we do that, let's just talk about some of the biggest moves happening in the market at the moment. On the back of the announcement of RFK going to head up the Health and Services Department in America, he's a big outspoken critic of the current system of food quality, healthcare, health cost, and the declining life expectancy in America, and the rise of chronic diseases, especially in children. So we're going to see a big shakeup in the American healthcare system, amongst other things as well, with this new incoming administration. And that's already having immediate knock-on effects in financial markets, even though it's not entirely clear exactly what legislation he's going to push through. And of course, we can expect a lot of pushback from the current establishment, which they've already started sounding the alarm. The same health experts who have presided over the dramatic rise in disease, at the same time pharmaceutical healthcare companies printing record profits. And the market is most certainly pricing this in. In fact, they saw it coming before the election. And now we got an announcement a day ago that RFK is going to head up the health agency. Some of these big drug stocks taking it on the nose today. Pfizer down 4.7%, which is a big move for a typically low volatile, large blue chip stock. Same with others like market darling Eli Lilly, who's greatly benefited from these GLP weight loss drugs. Got slammed today, down 5%, new multi-month lows here. Others like Moderna continuing to get hit hard, and especially biotech stocks. Amgen slammed these last couple of days. In fact, the whole biotech sector saw heavy selling today. The weakest performing sector, ETF, XBI, down over 5%. Really big move for a sector fund there, taking the whole healthcare sector off as well. And it's not just the big drug stocks, also the packaged food companies who profit from selling these cheap sugary snacks. They've been selling off hard these past few weeks as well. Conagra Brands, Campbell Soup getting hit hard again today. These are normally really low volatile stocks that most days just move 0.5% or so. And other candy makers, Hershey off 4.5% today. Warren Buffett's favorite that he actually owns, Kraft Heinz. Maybe Buffett got in there and bought the dip today as we put in a bit of a big hammer formation in this key support zone. And others continuing to slide, coming down to support levels here, Mondelez as well. So I'd say, even though not good for investors in these stocks, the drug and junk food stocks selling off, that's probably good news for the US consumer going forward, and maybe a tailwind for more health conscious companies, as there's likely to be a push over the next several years in America to try and make consumers more healthy, instead of the system incentivized for maximum shareholder profit of the drug and food companies. Because at least in these sectors, there needs to be a better balance between capitalism and people's health. And just quickly, before I show you the latest stock Nvidia's just bought, just a quick reminder, come back to the Click Capital channel on Monday night, because inside the Daily Market Review on Monday, I'll reveal my latest trading service, all the details about it, and why it's unlike anything you've ever seen before, which I'm sure a lot of you are going to find a lot of value in to help your stock trading. So make sure you come back on Monday night for that. Otherwise, let's dive right in and take a look at Nvidia's stock portfolio, along with the AI stock they just added, as we got their Form 13F. Applied Digital, ticker symbol APLD. They're a US-based provider of advanced digital infrastructure designed to support high-performance computing computing and artificial intelligence application. The company saw revenue growth of 67% year over year, and Nvidia likes it enough to have bought 7.7 million shares in it. This is a new position for them. Currently got a market cap of 1.56 billion. Headquartered in Dallas, Texas, the stock has been performing well over the last few months. Still yet to go cash flow positive. However, they do have really good revenue momentum. And just interesting to see Nvidia take a position in what is otherwise a pretty speculative stock. $7.20. Tiny market cap compared to Nvidia itself. Now over $3.5 trillion. That's 3,500 billion. Applied Digital here is just $1.5 billion. What Nvidia's value probably changes per second in trading is the entire size of this company. So they obviously see a potential future in it, and hence they want a seat at the table. And there's a look at Nvidia's other holding in their current portfolio. They got 6 stocks, just under $500 million in total value. Their biggest ARM holdings. That's the UK chip manufacturer, very important, and the semi supply chain. There's Applied, which they just added. Recursion Pharmaceuticals, which is a strange one to me, but the others make sense. Serve Robotics, which again is another highly speculative, almost kind of startup of a stock. They specialize in last mile delivery, partnered with Uber Eats, little robots driving around the streets, delivering food. And this is even more speculative than Applied Digital. They have pretty much next to none revenue, but with a market cap of 354 million, I mean, if they can pull it off, it's one of those stocks that could easily 10-20x in the next couple of years. However, it's going to be hugely volatile before then, even if they can pull it off. Another stock Nvidia owns a stake in that we follow here at Click Capital, SoundHound AI, voice AI solutions for heaps of different types of industries, and I'm more confident in this one than Serve Robotics. I think this is almost inevitable that voice AI will dominate a lot of industries, call centers, fast food drive-thrus, you name it. I think it's going to be pretty much everywhere within 3-5 years, and they're already partnered with some of the biggest companies in the world. And SoundHound, it actually has a bit of revenue already, and it's been growing pretty good as well. So Nvidia's got a seat at the table on this one. Still a relatively small market cap, 2.3 billion. And their last position in another really tiny, small and speculative company, NanoX Imaging, another health company, 342 million market cap, practically no revenue, and they're coming out of Israel, involved in medical imaging systems. So it's interesting to see Nvidia build stakes in these really small, kind of speculative companies that do have huge potential. And so maybe Nvidia and Jensen Huang have a vision for Nvidia to kind of become an AI conglomerate, not just involved in selling their own GPUs, but also potentially taking over one of these companies one day and swallowing them up underneath the Nvidia umbrella. Either way, interesting stories, and we'll keep following them here on the channel. So make sure you're subscribed if you haven't already, and I'll keep you up to date on all the latest trends and opportunities in the stock market. And just getting back to the bigger stocks, it wasn't a complete bearish breadth of a day. The rocket ship Palantir still well and alive, slapping on another 11% today. Just remarkable, this stock's run. Now one of the top performing large caps 2024. Just under 150 billion market cap. And Palantir is actually the largest position at the late Jim Simons Renaissance Technologies hedge fund, which was interesting to see. However, we also got news today that Palantir is trying to switch over from being listed on the NYSE over to the NASDAQ, which could potentially mean that they'll be added to the NASDAQ 100 index, the Qs, which has hundreds of billions of dollars around the world indexed and invested in them. And so even though Nvidia isn't breaking back, the whole semi industry is pulling back. Palantir appears to be in a league of its own, as there's just been a string of positive news announcement, one after the other, pretty much ever since they've been added in the S&P 500. But like I said, what might be spooking these big mega cap names is a few things, not just the threat of rates staying on hold, China tariffs, but also big funds and insiders selling stock. Amazon founder Jeff Bezos just dumped another 686 million of Amazon shares. He sold more than 13 billion worth this year. Also seen Jensen Huang sell some shares, Mark Zuckerberg, and along with Warren Buffett, significantly cutting down his holding in Apple. I'm wondering if they're worried about a potential nasty trade war that could last a year or two before it gets resolved. US companies could definitely be caught in the crosshairs if China retaliates. They do have some levers they can pull. The new administration looks to be stacked with Chinese hawks that are looking to take a hardline approach, in which we're still yet to hear how the Chinese plan to respond. I think they'll probably be waiting to see what's officially declared on them, for which I'd expect them to respond with at least something. Looking at their track record, they typically don't just sit there and take it. Whether they match the Americans one for one is yet to be seen, but America's already started to hedge its bet with a CHIPS Act in a dash to bring chip production into the States and insulate those really important supply chains. Taiwan Semi just got another handout from the government to build 3 more Arizona plants to manufacture and fabricate chips inside the States, instead of relying completely on Taiwan, which presents a tail risk. And so Taiwan Semi at 820 billion market cap, I continue to believe this will be one of the biggest and largest companies in the world for a long time, and wouldn't be surprised to see it into the top 5 and in the $1 trillion club in the coming months, if not year or so, because they're just so important for the world's semiconductor chip supply chain. And now they're diversifying out of Taiwan into America, Japan, and Europe. Pretty much think of them as a global manufacturer of chips, especially the high-end AI chips. However, it's not not just that, the doomsayers are out in full force. One strategist lifts recession probabilities to 75%. I'm starting to get deja vu from 2016. They're saying the benefit from tax cuts may be outweighed by the damage done by tariffs. Even though we may get a lowering of the corporate tax rate to 15% for domestic manufacturers and overall lower taxes across the board, this researcher thinks they'll be overwhelmed by the high cost of goods due to tariffs, which didn't really play out last time we got them. And like I've made a point of before, tariffs more affect discretionary spend and what's manufactured overseas. There's not going to be a tariff on people's rent. There's not going to be a tariff on locally made foods. There's not going to be a tariff on local utilities and other necessities, the stuff people need. But no doubt it could definitely bump up inflation, at least in the short term. We've even got some going as far to compare the current market to 1929, in which the Dow Jones Industrial crashed by almost 90% in the next 3 years. That's Tom DeMark, a long-time technical analysts, pointing out that the markets are really stretched here and that they're overly optimistic, which no doubt is true. Looking at the S&P 500 on the monthly chart here, my reversal signals are firing off on the monthly chart, indicating we could be getting near a point of exhaustion, as we have seen it before in minor market tops 2011, back there in mid-2007, reversal signals firing off. However, they can give false positives too early in the trend. It's more when you see a cluster of them, they become more significant, just like they timed the bottom in early 09. And they gave us a bit of a warning in 99 and 2000 as well, although we got some false positives during that mid-late 90s bull market. So we definitely could see at least the S&P 500 being close to an exhaustion zone here, or at least consolidate. However, what looks a lot different and is not nearly as stretched on the monthly chart, the Russell 2000 small caps, which is still not quite broken out to all-time highs set in November 2021. So like I said, you've got to distinguish between markets. People say the market's completely and ridiculously overpriced and stretched. Well, yes, there's an argument to be made there with the S&P and NASDAQ, mega cap tech. However, for small caps, international stocks, commodity-related stocks and others, not so much. However, I continue to see plenty of bearish pessimism across social media. With the winning post today, this one here. S&P, NASDAQ, Dow Jones, and the Russell have all topped, signaling the end of the bull cycle as we know it. Brace for a multi-year correction that could bring a 40 to 60% decline across the board. The warning signs are all there. This isn't just a dip, it's a start of a seismic shift. Be prepared. So I love it when people come out and say with certainty something's going to happen, and with no justification or analysis why either. However, the fact is no one knows for certain what's going to happen, not even Warren Buffett. And that's why I prefer to have loosely held theses until proven wrong versus closely held convictions that you tend to hang on to. But markets have been on a roll for a while, so no doubt we should expect some sort of larger pullback or correction in the coming months. Like I said, maybe Q1. We do have bullish seasonality. However, that volatility before the new administration's inauguration could come in earlier, especially if we get those pronouncements on Chinese tariffs. That could really upset this current bull run, along with Jay Powell, who appears to be pumping the brakes already a week after the election on his tune on the path of interest rates, saying yesterday, maybe we don't need a cut so fast. And what a change of tune it's been. From the July meeting, he said there's no need to cut interest rates. We're still not quite there on inflation. The economy's holding up. 2 months later in September, did the biggest dovish cut on record, 50 basis points right in front of the election. Now, a week after the election, flip-flop again, looking like he may only have a cut or two left in him. There's really no vision. He's just swing trading the data month to month and getting pushed around by the market and politicians, in my opinion. And the market is indeed pricing in the real possibility he may even be on hold come next month, almost getting to 50-50 here, whether they cut next month. And like I said, the media was reporting stocks came off hard today as the markets worried about interest rates. However, that Fed Fund futures pricing I just showed you didn't really change from the day before. And just looking at the 2-year bond yield actually came off today. So if that were to scream higher to 450, that would explain today's move. However, like I said, I think there's more to it. Mega cap tech, semis, China, healthcare stocks getting whacked, uncertainties about tariffs. I think that's all playing into the market's mood at this moment, along with a bit of profit taking and what's really been working well of late. Small caps pulling back here again today. However, that's what assets do in a healthy uptrend. Pretty much been the same case all year with small caps. They swing up and down all the time. But the good news is we still have signs of heavy accumulation and buying here. Every time we thrust up, we do so on big volume. But like I said on the 18th of September, when I thought Jay Powell was going to cut 25 basis points, is because I thought he should cut 25 basis points. I didn't see the data there for a 50 basis point cut, other than what the market and some politicians were screaming at him, why we had to give close odds that he would come through with a 50, which he did. But the fact is, the economy's still holding up, and it could indeed be warranted for him to keep rates on hold. Got a slew of economic data today. Import prices posting the biggest increase in 6 months. Price of goods coming into America, it's already going up. Tariffs is likely to add a tailwind to that. Manufacturing activity surges in New York to the highest level in nearly 3 years. Retail sales climbing again ahead of the holiday shopping season. And I agree with the narrative of this article here. American consumers are a hardy bunch. You have to keep them locked up to stop spending. Retail sales gained 0.4% in October, a little bit ahead of what economists were forecasting, 0.3%. Rising 2.8% on an annual basis. Demand for cars and car parts helped push the headline figure higher. And I think we could actually be shaping up for a pretty good holiday spending period, and definitely online as well. But there's a look at the retail sector, which has been bumping around all year. Actually pulled back a little bit today. And I'm actually surprised how well it's held up, given the threat of tariffs and how many retailers import their goods from China. And so let's move on to China for a minute, because this is going to be one of the biggest themes affecting markets, not only currently, but for the next few months for sure, as we don't really know how these tariffs are going to play out, what exactly we're going to get, how China's going to respond, along with how the markets are going to digest it. We may get a bout of volatility while the markets process all this. So far, we're starting to see some green shoots in China getting underneath their deleveraging, their stimulus, already starting to get consumers feeling a little bit better, consumption starting to turn back up, and we saw that again overnight as well, with Chinese retail sales also beating October forecasts, and an encouraging sign for their economy. With retail sales expanding 4.8% year over year, big bump up from the 3.2 in September. And what gives me hope and optimism that we won't see China completely shut out of Western capital markets like Russia was, is that China absolutely dominates in rare earth elements. They have the biggest reserves in the world by a lot, more than a third, and America actually relies on China for a number of rare earth elements 100%. And so even though we may get a showdown, a market tantrum, definitely some volatility, I'd like to think ultimately, and it may take a year or two, the Americans and Chinese can actually work out something that's mutually favorable and hopefully pull China closer to the international stage and encourage more free and fair market practices with the US and other trading partners as well. But they are determined to get underneath their market. They're in fact guiding their listed companies on how to get underneath their own company values, their market caps, urging them to do buybacks and other methods to put a floor in their markets. And some Wall Street firms are warming up to them. Citigroup raising China GDP growth prediction 5% for this year. And what adds to my confidence to invest in Chinese securities myself is some of the biggest and best investors in the world doing the same thing. David Tepper got almost 40% of his portfolio in Chinese shares. He's more of an aggressive Chinese bull than I am, as my overall allocation is nowhere near 40% to China. But as we get in the Form 13Fs roll in, we're getting more news of some of the best hedge fund managers out there doing the same thing. Q2 Management bought $250 million in Chinese internet shares ETF KWEB. Saw the same thing from hedge fund manager Lewis Moore Bacon. Bought hundreds of millions of dollars in KWEB call option. And there's a look at KWEB there. Like the whole Chinese sector has been pulling back since early October. But some of these hedge fund managers have been buying the dip. Just like I did today on one of my favorite Chinese names, Alibaba. And this is a stock I alluded to at the start of this video. I was going to let you guys know what I bought the dip on today. I bought Alibaba at $88 a share. The number 88 symbolizes fortune and good luck in Chinese culture. However, that's not the reason why I bought stock today and I'm a long-term holder in it. It's quite a few things. And I think the late Charlie Munger, who was also a Chinese bull, will be ultimately proven right. And I think these uncertainty of tariffs create an opportunity, in my opinion, because they'll stimulate as much as needed to get underneath their markets. And there's nothing more powerful in markets than government intervention. And Alibaba did come in with a beat today, which I'll show you soon, all their numbers. Pretty good result. Once again, the market's too nervous to buy it. Actually came off a bit today, and hence why I took advantage of that in my own personal account. So all in all, pretty good result considering the condition of the Chinese economy. Revenue came in 5% year over year. Same deal with income. Adjusted EBITDA came in a little bit lower thanks to a little bit of capex. But overall, the business is still really healthy, getting some big growth in the international digital commerce, AliExpress, for which they sell to consumers all around the world. And they really just dominate in Chinese commerce. Got a hugely growing cloud business as well. Very profitable. And what's really got me excited as a bull is just their huge buyback of shares. They bought back 2.1% of shares in the previous quarter. That is huge. Annualized, that's 8.4%. They're just gobbling up as many shares as they can. They're also buying their dip with their huge cash reserves. And this is what Chinese regulators actually want them to do. And they still have 79 billion of cash and cash equivalents, meaning they can still buy back more than a third of their market cap. And so this is a long-term position for me. This is not a swing trade. And if I get the opportunity to add more shares down in the low 80s, I will continue to do so. As I believe this uncertainty, which like I said, is likely to have a few more months to go, could get worse before it gets better, could be setting up a really good opportunity, in my opinion, to buy the dip on Alibaba. And just as a reminder, this is not financial advice. Please do your own research. I'm just sharing with you my opinion and position in this. And there's a look at Tiger Brokers as well, still hanging around the mid fives. Like I said, the whole sector's been pulling back ever since early October. Now trading at a lower price than when billionaire David Tepper went on CNBC and said he's buying everything China. And just moving on to another company that I'm currently long and has had a bit of a pullback these last couple of days. Hims and Hers Health. Stock's been selling off on the news of Amazon's further push into telehealth, with their One Medical launching a new service that offers upfront pricing for telehealth visits for a range of issues. And so no doubt this is a little bit of a threat to Hims and Hers Health, which operates a fastly growing telehealth service and kind of a secular trend in how consumers access their healthcare. And it's definitely punished the stock these last couple of days, coming off sharply here. I'm still above water where I got in the low 15s. However, for now, I'm still currently holding because I still believe in Hims and Hers Health long term. I think they can survive the Amazon threat. They're a pure play on this telehealth. And we've seen this with Amazon, which is kind of like a giant squid, tries to get into everything. And it's just a story as old as time, jack of all trades. We've seen this time and time before. There was worries they were going to take out Netflix with streaming. They were going to overtake food with Whole Foods, convenience stores. We've seen it before that they were going to target Carvana. But what Amazon really dominates in is e-commerce. There's pretty much no company in history that can just get into every and any industry at once and completely dominate. But like this post here, I think Amazon's really going after Walgreens and CVS and prescription. I don't think they're really targeting Hims. We are getting signs of some Hims insiders adding a few shares to their position after this recent sell-off. The fact is, just looking in America, Hims is still the 6th most popular free healthcare app, and the business has been growing like crazy this last year or two. And you can see that on my fundamental chart, really strong momentum and revenue. However, no doubt we're in for a bout of short-term volatility like we've seen the last couple of days in some of these small cap names. But as per usual, I'll follow the trends, and as long as the stock is uptrending, I'll continue to remain long. But even though Hims was off really bad today, Stock Picks portfolio actually finished up today, managed to bounce back after a down day yesterday, thanks to another stock I hold, Intuitive Machines. Came out with earnings yesterday, massive gap up, huge sell-off into the close, then another big bounce here today, 21%. Like I said, we're seeing a lot of volatility in some of these hot names of late, with other space stocks bouncing up today, Rocket Lab, and some of the nuclear trade stocks coming off a bit hard today as well. Sam Altman's Oklo down 24% after their earnings, causing a little bit of a pullback in NuScale. Nano-nuclear energy held on a bit better, but also having a bit of a pullback. Quantum computing, some of those stocks getting sold off today as well. Also, there's got news that Warren Buffett added Domino's Pizza to his portfolio. Buffett's famous for investing in junk food. Coca-Cola being one of his biggest long-time stakes, Kraft Heinz, Mondelez. Buffett knows these cheap sugary snacks and other types of fast food will always be around. It's just up to the regulators to make them more healthy. Berkshire bought 1.3 million Domino's shares worth $550 million. Domino's has more than 20,000 restaurants around the globe, majority which are run by franchisees. US same-store sales rose 3% year over year in their latest quarter, and they had suspended their goal to open more than 1,100 new stores this year, put a bit of pressure on the stock. However, it did get that Buffett bump as we got news. Huge gap up this morning. Looks like a bunch of sellers came in there, took advantage of it, actually finished down on the day. Not even Buffett buying caused the stock to finish high today. And here's an interesting graphic using data from all the latest Form 13Fs of hedge funds and what positions they currently have, looking at activist funds, event-driven funds, and legal distressed funds. You're welcome to pause your video player, take a screenshot, and use this as fodder for research. I certainly have myself. Also interesting today, we're getting news from the new admin looking at a potential no capital gains tax on Bitcoin and other US-linked cryptocurrencies. So it looks like this new admin is serious about really getting behind crypto, not just being pro-crypto to win the vote, but actually making good on their promises. It's going to be another interesting theme and story play out over the next year or two that we'll be watching here on Click Capital, as there's really no precedent for the world's largest government closely adopting private currency, potentially using Bitcoin as part of the strategic reserve. And there's a look at Bitcoin holding ground above 91,000, even though we're definitely a little stretched here short term. Wouldn't be surprised for it to take a run to $100,000 any day or week now. If not, we may get that pullback, and then by Christmas, barring any major surprise, this thing's just been lit on fire. It's going to take a lot for it to really break into a downtrend now, especially since we're getting reports that one of the biggest crypto hawks out there, SEC Chair Gary Gensler, is looking increasingly likely that he'll step down voluntarily and choose not to finish out his term as SEC Commissioner. Looking like the crypto bros are winning after all. In my opinion, the only thing that could really cause a big pullback in Bitcoin is if the whales, who own most of it, start offloading, which we're getting a little bit of news about already. A Satoshi-era Bitcoin wallet just moved 2,000 Bitcoin worth $178 million, making its first activity in over a decade. So just keep in mind, Bitcoin ownership is highly concentrated amongst the whales and the early adopters, Michael Saylor, and others like that. In fact, almost 90% of Bitcoin is owned just by 1.3% of all Bitcoin addresses out there. In my opinion, it's not a currency of the people, but a currency of a handful of whales who are immensely benefiting from this pile-on to the non-yielding and non-productive asset of Bitcoin. Certainly has been working very well for them. And finally today, ending on some news, Elon Musk's SpaceX preparing to launch a tender offer next month at $135 a share. So a tender offer is offering existing shares for sale, allowing some exit liquidity for current investors in a private market. And that currently values SpaceX at more than $250 billion. That's incredible. Personally, I think SpaceX will be worth more than Tesla one day, and I really hope it comes onto the market in the next couple of years so I can buy some shares in it and make it another lifelong position for me. Because there's really no limit to the SpaceX business, and they're going to lead the charge. And like Elon Musk's life mission that he's been dreaming of ever since he's been a little boy, to make humans multi-planetary, extend the light of consciousness, as he says. And he's going to lead the charge of taking us to Mars. And honestly think within 10, 20 years, we may have bases on Mars that look just like this. Not to mention opening up a whole slew of new industries, products and services, which SpaceX could dominate. Not to mention the ones already on Earth, Starlink, which they've got, Internet Anywhere, which is a massive reoccurring revenue business in itself. Just Starlink alone could be worth hundreds of billions of dollars. Not to mention all the other services SpaceX is involved in. And so like I said, the space ball may have already started. These other stocks, Rocket Lab, Intuitive Machines, a few others, could continue their rally into the SpaceX IPO, which like I said, we don't know exactly when it's going to come, but I'm hoping in the next 2-3 years would be nice. Either way, it's another exciting secular trend I'm happy to be invested in amongst a few others. Otherwise, that's a wrap for this week and the Daily Market Review, guys. Thanks very much for tuning in, and I'm excited to reveal my new trading service on the Daily Market Review this coming Monday. So have a great weekend, and I'll see you then. Cheers.